Welcome to the Asia Advantage series on opportunities in emerging Asia. This is Mary Field of Dezan Shira and Associates Beijing office. I'm here with our national tax partner, Sabrina Zhang. She's ready to discuss some of the topics from the presentation Fund Repatriation she gave in cooperation with the Israel Chamber of Commerce in China at the World Financial Center here in Beijing. She'll discuss profit repatriation, royalties, service fees, and payment on behalf. Sabrina, over to you.
Hello everyone, this is Sabrina. So I've been a consultant, so we've been very often asked by the question by the foreign investors come to China, to do business, and they ask me the question how we can get the money out. I think that's normally on the different stages. That could be before they come to China for business, just on the planning stage, someone already, think about in the future how to get the money out, or sometimes it's in the process of setting up their company because they have some pre-startup, expense to put in China. And also that could be also in the stage, once they already have the company here and then make the good profit here and then think about how to get the money back to the headquarters. However, normally they will find various kind of difficulties in this process. So that's why today we put together this, the slides just to walk through with everyone about this fund repatriation from your China entity to overseas. So we're going to talking about various ways you can get the money out, and also the tax implication, and also the foreign exchange control implications, so we could know the tax and the repatriation procedures, per each kind of the way. So let's start with the first one, profit repatriation. That's the I would say the most common way the company make the funds to overseas. So this is normally when the business already been set up here and also make a profit over here, and then the money has been put out in name of dividend. Before you could send out this dividend, there are some preliminary conditions the company have to meet. For example, the WOFE in China tax law, they allow the WOFE can carry forward the loss over 5 years. So if in the current year you make the profit, and the first step is you have to look it back. If you have any carry forward loss, still could be deductible. And so that's the first, the consideration. The second one is the WOFE have to accrue 10%. It's kind of like a common reserve under the equity section. That one doesn't mean you have to set up a different bank account or you have to get the money saved in a special account. This is just a purely accounting entry. Make a reserve of 10% of your net profit. And then afterwards, you may also consider about if the cash flow is sufficient enough for the WOFE. As you may know, in China, the WOFE is not freely you can get the funding from headquarters. So that's why sometimes even you have the pretty good cash flow now, but maybe for the future investment or the future the business transactions, then maybe you also need to prepare sufficient enough cash inside the WOFE. And also you have to look back, if there's any outstanding tax payments still there. Then finally, the board of directors of the WOFE have to make a final decision and pass a board resolution officially signed by all the board members. Then the tax implications with regard to the dividend is normally 10% withholding tax. The withholding tax is tax on the passive income, normally on the profit, on the royalty or interest, we call passive income in China. So the 10% right now, this is the flat rate to the standard company, but there may be also other preferential rates such as 5% to commonly used, for example, the Hong Kong holding company or Singapore holding company. So under the double tax treaty, the company may claim a preferential rate or tax exemption for the dividend. So the dividend shall be the dividend tax shall be withheld at the source. So WOFE normally shall be acting as the withholding agency on behalf of the headquarter. And also the WOFE need to submit to the tax authority and withholding statement and also other material for such, the profit distribution resolution made by the board of directors. In the later slides, we will show what's the tax obligations and also the detailed procedures for repatriate profit. The tax obligation triggered from this declaration day. So as you know, for some of the large company, especially listed company, after they have this board resolution, and they may officially have a declaration day for dividend payments. So if the payment is after the declaration day, then actually the tax obligation start from the tax obligation, the tax declaration date. However, if the payment is before the declaration day, then the withholding obligation starts on the day when you make this profit, when you make this payments. Here comes to the detailed steps for the profit repatriation. So initially, when the board resolution is finished, so the WOFE shall file this board resolution with its in-charge State Tax Bureau within 30 days. And then, the WOFE could apply for some tax preferential rate or exemption. There are two kinds of tax preferential way the WOFE could apply. The one is the exemption on the dividend generated in or before 2007. As you know, China been through a CIT reform in 2008. So before 2008, there is no dividend tax on the foreign invest enterprise. That means that's zero for the profit repatriation. But after 2008, then there will be a 10% dividend tax, which is equalize the treatment to both the foreign company and domestic company. So if you could prove, the dividend right now you declared, including the ones, before the 2008, then the company could have the opportunity to apply for the tax exemption for that part. The second kind of exemption or preferential rate is under the DTA, that's the double tax treaty benefits, which provided in the certain regions or countries, they could enjoy the beneficial rates. The company, in order for the WOFE to apply for such, the tax preferential arrangement, then you have to make the official application from the tax bureau. So in the later slides, we show the the detailed requirements for this DTA benefits. So the documentation will be a tax resident certificate. So normally that have to be issued by the home country of this holding entity. Normally the tax bureau will issue a tax resident certificate for the years where it belongs to this the dividend. And then there is other very important statement is a beneficial owner statement. As you know, China actually stopped giving this DTA benefits to this the virtual type of the holding company, because they understood a lot of company before they make the investment into China, they may be just for the tax purpose, the particular the transfer this investment via some tax efficient jurisdictions such as Hong Kong or Singapore. The tax bureau actually decide the tax preferential rate only given to the real beneficial owner. That means you have to be a real operational company rather than just a paper company or shelf company in the offshore jurisdictions. So in the later slides, we show the justifications normally the tax bureau will look at. So there are 5 main factors to be considered. For example, if the dividend paid to the holding company, are they going to oblige to further repatriate it within a certain short time? Or, if they have the real operation activity or not, and how much is their, the fixed asset, business scale, and the number of staff. And also if this holding company located in any tax jurisdiction which provide no tax or grant tax exemption on dividend. So the taxpayer, the WOFE, has to declare all the detailed information about this holding company and also provide, the financial statements of that entity for the tax bureau's assessment. Then come down to the step 3. So once the WOFE, they already make the assessment on if they could enjoy the tax benefit or not, then later on they could just process, the tax payment. So normally in Beijing right now, this withholding tax can be done in every month from the beginning, to the 20th of that month. And normally within 1 or 2 days, then you can get the tax receipts after the payments of tax. So after this procedure, then you can directly repatriate the money through your corporate bank if the amount of the dividend repatriation is less than $30,000. However, if the amount is beyond that, then the company have to further apply for a tax certificate from its in-charge tax bureau. That will be including both the local tax bureau and the state tax bureau. So after you get this tax clearance certificate, then the WOFE could make the remittance from its corporate bank account. So you can see this is quite a lengthy procedure, and also that could take for a couple of months, just to finish this process. In the next slides, we're going to talking about the royalty payment. Lots of times, the WOFEs in China, they may engage with the headquarter for certain payments, the IP-related payments, such as for use of patents, copyrights, trademarks, and technology. And also sometimes, they arrange these payments, in name of licensing fee or technical, a transfer or technical support type of fee. So for any technical technology-related contracts, there is a special requirements to file, such contracts to the MOFCOM, and also the company have to have this technology import license in their business scope. So some of the WOFEs, if they don't have such a scope initially, then they have to further enlarge this scope from the MOFCOM approval. The tax obligations for the royalty is a little bit different than the dividend payments because they have this additional 5% business tax. As you know, in China, the company not only have to pay the corporate income tax, but also there is a turnover tax, such as business tax and the VAT. The business tax so far is posed on the royalty payments and the service fee. So that will be 5% business tax to most of the service industry. However, there are also other rates, the business tax rates to the different kind of like a service sector. But for most of the WOFE who deal with the royalty, then the 5% will be the applicable rate. In addition to the business tax, there are also 3 other surcharges, such as urban construction maintenance tax, education surcharge, and the local education surcharge. Altogether, this 3 surcharge will be 12% on the turnover tax. So normally that will be paid together with business tax. If we put it all in consideration, so the total turnover tax will be 5.6 together on the royalty. And then, as you know, Shanghai already started this VAT pilot the program. So for the entities, if you are already being transferred from the BT taxpayer to the VAT taxpayer, then the royalty will be subject to 6% VAT plus also the surcharge. The royalty is still 10%, on the royalty type of payment, unless there is a double tax treaty provide any preferential rates or exemption. The royalty payments is also the tax shall be withheld by the WOF. For the timing of this the tax obligation, then it depends on the contract date. So if the payment of the royalty is processed on the payment date stipulated in the contracts, then that will be in the contract or before the contract date, then that will be the payment date. However, that happens very often. It's like if the contract is between the holding headquarter and the WOFIs, maybe although they have the contract, but the WOFI won't really process the payment regularly due to their cash flow the problem. So if the payment actually is happened after this contractual date, then the withholding obligation still arises on the contract date. However, the tax bureau sometimes they could give this a concession. So normally they will see if before your annual tax CIT return, the deadline for that, before that deadline, if you already process this tax withholding, then that is still okay. You could put this royalty type of cost under the WOFIs, the financial statements. Otherwise, you may have to do a CIT adjustments, and when you calculate the annual CIT obligation, then this royalty payments have to be adjusted out from the cost of the WOFI. In this slides, we give a detailed process for the royalty repatriation. So that will be, for example, you enter into the contract with the headquarter, and also you have to file with the MOFCOM if there's any technology-related terms in this agreement. And also, you have to register these contracts within the tax bureau in the 30 days of the contract conclude, and apply for the withholding tax, beneficial withholding tax rate under DTA, and fulfill this withholding obligation, and then also apply for this tax clearance certificate for the payment amount more than $30,000. So then once you have this tax clearance certificate, then the payments can be repatriated from your corporate bank account. So for the third section, talking about the service fee, so this is normally for the payments between the headquarters and the WOFIs. So they could be, the services provided, from one entity to the others. So that one, is just between the two companies. You could conclude a contract, and then, the company can also make the payments, just like you're engaged with the other any third party, the vendor payments. However, if this is a service contract which relate to any technology-related consulting or design or research, that type of the service. Again, this will be similar like the things we discussed under the royalty section. The WOFI have to register with the MOFCOM for such contracts, and also they have to make sure in their scope they are allowed to do this technology import and export. The tax rate for the service is also on the both sides. One is on the turnover tax side, so that would be similar to the royalty. There's a 5% business tax plus surcharge. Or if the company are in the VAT pilot area, they will subject 6% VAT. The 6% actually is on the normal, the consulting or service section, but there are also maybe other tax rates on the VAT. For example, 11% on the transportation services and 17% on the removable property leasing section. And then there's also the income tax going to apply, which is the 25% corporate income tax. Maybe a lot of people will think about under the royalty section, that's 10% withholding tax. And for the service fee, that's 25% CIT. Then they may think, under the service section, the service fee, then the tax obligation could be significantly higher than the royalty charge. But actually, they are not charged on the same base. The withholding tax actually is the taxable base is on the entire invoice amount. However, the CIT is only on the profit. It's not really on this invoice amount. But how does the Chinese Tax Bureau decide the profit of the foreign entity? So they normally use a deemed profit rate, and they have given a range for this deemed profit rate, which is from 15% to 50%, which depends on the industry of the foreign company. So very often, if this is just a typical advisory service, then the deemed profit rate normally is arranged from 20% to 30%, which is the most commonly used rate. So this CIT is only posed on the foreign entity if you are deemed as the PE here in China. The PE is the tax terminology, permanent establishment. That's actually the concept of the PE is, for a foreign company, although sometimes you are not really officially registered an office here in China as a RO or a WFI, however, the company does send their staff or personnel, come to China and to provide, the service. And if that time period is over certain dates, then under the China tax law, then that will become a PE here in China, which will be subject to the China CIT law. So for most of the countries who have already engaged with China with DTA, then that's 183 days. That's the trigger, the time. But if without the DTA, then that will be only 90 days. That means if you have any projects here performed more than 183 days, then this foreign company will become a PE and will become subject to CIT here in China. So the procedure for process of the service fee is still start from entering the contract with the headquarter, and then you present this contract and register this contract within its in-charge tax bureau within 30 days, and then the tax bureau will make assessment and to see if this is a qualified a PE or not. Afterwards, then the WFI will do the withholding tax and also obtain the tax clearance certificate before they make the money out. I think that the very special things, under this service fee section is, we have been observed, the attitude from the tax bureau actually become more and more strict in the recent years on assessment for such contract, because they knew for the headquarters and the WFIs, they are related parties, and sometimes the contract, the term, they could really make, out whatever in favor of this, the tax. So they may just try to avoid, become a PE and pay CIT. They may, especially, to put the, the wording such as they may limit, the period of the contract within 6 months, or they could come up, whatever service item, they want, just try to get the money out. So right now, the tax bureau, if you just present them with a very simple contract, like 2 pages or 3 pages, just general say this is the advisory service and this is how long time, sometimes the tax bureau won't really accept such contract. They want you to provide more details. For example, your detailed work scope, and also, for example, your team to be assigned on this the projects, and also their timesheets, so that looks like more sort of like a real contracts and real, the people to be like working really under for each the contract. And sometimes we've seen the cases happens like even in the contract you mentioned the period is within the 6 months, but the tax bureau say because it's not easy for us to justify how long is the periods of the contracts, then we still deem you as a PE and the WFI is still subject to pay CIT. The last section is about the payment on behalf. So this is happens actually quite often when the company initially just registered or sometimes even you have already got the WOFE here, but some of the expenses has already been paid by headquarter, and headquarter wants somehow charge back this cost back into the WOFE. Under China foreign exchange law, it does provide some kinds of items. The expense items could be under a chargeback. For example, for transnational corporations, normally they are the large, the entities who have a very significant foreign exchange transactions per year that have to be granted by the SAFE, that State Administration of Foreign Exchange in China. So for such transnational corporations, they allow to process certain chargeback, to the headquarter. For example, like expatriate salary, bonus, and subsidy, and expatriates social welfare, overseas traveling, and also the management fee, such as the R&D or marketing type of the fees, and other expenses should be proportionate by this transnational corporation. However, those cost chargeback only apply to this transnational, which means large, the international companies. For the smaller or middle size of the corporations, the cost chargeback are only limited to the three items. That's for the expatriate salary, welfare, and also traveling. But a lot of times, actually, there are a lot of other kind of like expense items being paid by the whole headquarters. But due to there is no clear indications in the foreign exchange regulations, so normally the bank won't be able to process this kind of chargeback without asking for the tax clearance certificate. So that means if this is not a qualified reimbursement applied under this safe rule, then that's difficult to get the money out. So but how to deal with this unqualified reimbursement causes? So we provide here 4 different alternatives. For example, the first one is maybe you will just enter into a service contract with your headquarter. However, like we mentioned in the previous slides, for this service contract, then there will be the tax implication involved. For example, 5.6 together, that's the turnover tax, and also that may subject to CIT if the foreign company will be deemed as a PE here in China. And also there are a lot of like paperwork. For example, you have to conclude the contract, you have to get assessment from the tax bureau and apply for the tax clearance certificate, before you could get the money out. So the first alternative, you will see the tax implication will be a little bit heavy, and also the cost for process, the such payments also going to be a little bit high. So the second alternative is simply you could just book this, make this accounting transaction, put it in your WOFE books as accounts payable, but you will never be able to get the payments out. As you know, under the China accounting rule, if this accounts payable remain in the books for more than 2 or 3 years, and then you could not really still foresee in the future you couldn't make this repatriation out, then under the Chinese the tax rule, then that should be adjusted back to the income, and then that could be subject to the CIT tax for the WOFE. Although this is not normally been very strictly followed. For example, if you use the local auditors, sometimes they won't really ask you to make such adjustments. However, normally if this is the Big Four as your auditors, and they may go strictly under this tax rule, and they may ask you to do this tax adjustments for the CIT purpose. So for this method in alternative 2, you will see actually that will be very simple, because you don't have to make this tax assessment, and you don't have to do the repatriation. This is normally used by the WOFE because anyway, they just want to make this a chargeback under the WOFE so that the WOFE could take this cost, to show on their books, but they may not really wish to get the money out due to the cash flow consideration. However, the cons is for this scenario, the potential risk is still your auditors or the tax bureau in the future could ask for tax adjustments for this long unsettled accounts payable. For the third alternative is the foreign headquarters just pay on behalf of the WOFE, but you don't really charge back to the WOFE. I think that's the easier way is all the costs, that's only show on the headquarters book, but not really inside the WOFE's books, so that save WOFE's time and cost in figure out, how to do this, the money repatriation. However, the cons is then the WOFE cannot really claim this cost as the deduction in their P&L and in their CIT calculation. This is probably not good when the WOFE, you accumulated a lot of profit already here in China, and you cannot really show your related, the expenses all under the account. So the final one, this is very often, happen to the newly established company, is sometimes, before the WOFE set up, as you know, there's long procedures to set up the company and also to get the bank account, opened. So before that, a lot of times the investors have to initially run the office, and also probably they already get the staff working to them, during those transition time. So there's a lot of expenses happens already. Then the foreign investors, they just transfer the foreign exchange, into the employee's personal account to settle, all this initial startup, the cost. So this could be an easier solution for the smaller amount settlement. However, there is the limitation for the individual under Chinese foreign exchange rule. Each year, the individual can only allow to make the conversion up to 50,000 US dollar. And for expatriate, the same limitation applied. And further, they have the limit on the daily, the conversion. So if you try to do in this way, so then there will be the internal risk, the control risk, for this internal control. And also, if you have a large amount of settlement need to deal with, for example, also have to pay the procurement for the furnitures or for the fit out, then you have to send it to many private accounts, then that won't be easy to control. So you will find out actually, even we've been given four alternatives, but actually each alternatives have the pros and cons. Finally, there is no ideal solution for this issue. Unfortunately, this is still the fact actually under the current situation, because now under the foreign exchange rule and under the tax rule, there is no clear regulations provide on this cost chargeback. So somehow, if you really want the money out, or if you really want the cost to be appeared, in your WOFE's books, then you have to, choose either of those four ways. But then the various, the pros and the cons, which we just mentioned, in the previous slides. So finally, we will like to give a summary on this tax liabilities on these four kinds of, the money repatriation we talk about today. So like I said, today we're talking about the money repatriation in name of the dividend, that's the profit repatriation, in name of the royalty, and also in name of the service fee, and also the cost chargeback. So then on the tax side, we're talking about the turnover tax, which is the business tax or the VAT tax, and also the corporate income tax, that's the CIT or the withholding tax. So let's look at them, each way of the repatriation and their the tax obligation. So we start probably from the most the heavy tax burden, the method. that will be actually the dividend. Although dividend through this chart, you can see that's only applied to the 10% withholding tax. However, the dividend is declared after the WOFE already paid 25% CIT. So that means you already finish off the 25% dividend tax, and then further for the dividend you want to repatriate, you have to make a further 10% on this dividend to be repatriated. So then you can see the dividend tax is still actually the most heavy, the way you get the money out. And then the next one is the royalty. No business tax, turnover tax. However, they have this 10% withholding tax still apply on this chargeable invoice amount. And then the next one will be the service fee. So under the service fee, if you will be deemed as the PE, then you will be subject to both the turnover tax and the CIT tax. As the CIT tax is charged on the deemed profit rate, let's just give an example. Say, the deemed profit rate is 20%, then the CIT 20 times 25% will be 5% together on the invoice amount, plus another 5% business tax. So altogether, that will be 10%, the total tax burden on the invoice amount if the service fee is charged as a PE. However, if you could successfully claim to be not a PE here in China, then that's only subject to 5% business tax. Of course, that's also the other, the small surcharge. That's the 0.6%, the surcharge there. So that could be the less expensive than the PE scenario. So finally, the least the tax burden will be the payment on behalf. That's the cost chargeback, where the company actually you don't have to pay any tax and you could just get the money back. However, under current foreign exchange rule, there are not many items, the fee items you could do where there's a cost chargeback. Even the expatriate, the salary could be repatriated as cost chargeback. However, that one actually still the WOFE has to withhold individual income tax in advance. You have to show this certificate before you can get the salary repatriation. I think that's finished off my presentation today. Hope that use to your business analysis. Thank you very much.
Thanks for joining us today. Please visit our website at www.dezshira.com. That's DEZSHIRA.com